First off, welcome from Nashville. Thanks to those of you joining locally and nationally. This is the fourth installment of Next Normal, which is a series of interactive webinars brought to you by Vanderbilt Executive Education and the Nashville Area Chamber of Commerce. Next Normal strives to connect businesses and business leaders with content and resources to help our communities successfully navigate a business environment that's undergoing significant and sometimes existential change. Today, we're going to focus on how to speak the language of business. We'll cover essential financial concepts and how to use them for analysis, and you'll be able to bring those skills to bear immediately in your work. This series is just one example of the safe, socially distant programming that Vanderbilt Executive Education has been delivering for business leaders in areas like leadership, strategy, and innovation throughout the pandemic. Our live online programs help fill particular knowledge gaps or increase overall competency in leadership, strategy, or management in a highly interactive virtual setting. Our next live online program is Speaking the Language of Business, conducted by today's presenter and other Vanderbilt accounting faculty in 4-hour segments from May 17 to 21. Today's webinar is full of useful knowledge, but the live online program will give you a comprehensive set of skills that will change the way you manage financial resources. If you own your own business or have budgetary responsibilities at work, this is the program for you. I'd highly recommend it. I'd note that Speaking the Language of Business is also the last live online program we'll be offering until the fall. We've still got a lot of other learning opportunities, from tech boot camps to business management certificates. So please check out business.vanderbilt.edu to learn more. At the end of the webinar today, we'll share with you the names and contact information of individuals you can reach out to if you have any questions, along with the website URL. Before I introduce today's presenter, I'd like to give Stephanie Coleman, Chief Growth Officer at the Nashville Area Chamber of Commerce, an opportunity to say a few words. Thanks, Stephanie.
Thank you, Nate. It's a pleasure to be here with you all. I'm really looking forward to today's program. Really excited about this partnership that we've had with Vanderbilt Executive Education for the Next Normal series. We've been partnering on this for really throughout the entire pandemic over the last year, and we're always thankful for the high quality and interactive programming that Vanderbilt Executive Education provides. And not only do you all provide strong content, but you get real world examples of how to grow both professionally and personally through these programs. The Chamber created the Next Normal series to really help with the plan for reopening and restoration of businesses right toward the beginning of the pandemic. And really, it's been a tremendous resource for the business community as they've navigated this past year and are looking toward a brighter future now that the vaccines are out and people are beginning to get back into offices and back out in the community. We know that many businesses have experienced some form of financial challenges, especially during the pandemic, and a strong financial foundation is critical to any business, and particularly those looking to rebound this year. And that's why we're so excited to hear from Professor Richard Willis and are grateful for him for sharing his expertise with us this morning. Along with great content providers like Vanderbilt Executive Education, the Chamber will continue to be your partner in the Next Normal. Now I'm going to hand it back to you, Nate, to get us started.
Thanks, Stephanie. So it's my pleasure today to introduce you to Richard Willis, the Anne Marie and Thomas B. Walker Jr. Professor of Accounting at Vanderbilt's Owen Graduate School of Management. Highly regarded by his students, Richard Willis has extensive experience in accounting and financial reporting and a distinguished body of scholarly research. He's frequently recognized for excellence in teaching in the U.S. and abroad. That includes the Daimler Chrysler Award from the Fuqua School of Business and the James A. Webb Jr. Award for MBA teaching from the Owen School. He serves on the editorial boards of several leading journals and is published in several more, including the Accounting Review, the Journal of Financial Economics, and Contemporary Accounting Research. His research focuses on security analysis, firm disclosures, and shareholder litigation. Before I introduce Professor Willis, for sure, just a couple housekeeping items. If any questions pop up during the course of the webinar, feel free to put them in the Q&A, and we'll be able to address them at the end of the session. So without further ado, Professor Richard Willis.
Thank you, Nate. Thanks a lot. I'm very happy to be here with all of you this morning. We thought we'd start off with a poll just to get a sense of where everybody is with assessing their financial acumen, and I believe Nate's going to launch that for us here, asking you how you would rate your financial acumen.
Answer's still coming in, going to give it a couple more seconds. Alrighty.
Okay, great. So it looks like about 58% of you have some basic knowledge. We got 2 experts out there, so that's great. And then I think our second most common, about a third of you would assess it as solid understanding, and some of you are completely green. So we have something, I think, for all of you. So let's see here. I'm going to stop sharing the results there, and I'll advance my slides. Get that to go away. Okay. So as Nate said, the title of the talk is the language of business. And really, if you think about financial reporting, it is a language. And really, it's all about communicating financial information about the performance and status of a business enterprise to constituencies outside of the business. And the primary source of this information are the financial statements. And the purpose of financial statements is really to facilitate decision making. Regulators also use them as an early warning signal for potential additional investigation. And I'll actually touch on that a little bit at the end. There's 3 primary financial statements. We have the balance sheet, the income statement, and the statement of cash flows. And we'll talk about each one of those, that's information and uses. We'll talk about nice and intuitive ways to summarize the information contained in those in the form of financial ratios, and also decomposing those ratios so that you can glean additional insights. And benchmarking. Very important to benchmark performance to assess how you look relative to either yourself historically or peers with whom you may wish to compare yourself. Talk a little bit about free cash flow and earnings calls as well, which are a very useful source of information. So if we think about the 3 primary financial statements, we have the balance sheet, we have the income statement or the P&L, and we have the statement of cash flows. And we'll begin with the balance sheet, which really summarizes the financial position of an entity on a specific date. So that's a key notion here, is that this is at a specific point in time. And then the income statement and the statement of cash flows are what we call flow statements, which they summarize information during a particular period of time. And we'll cover all of those. We'll start with the balance sheet. So the balance sheet satisfies the identity that you see here on the left. Assets equals liabilities plus shareholders' equity. And I define those initialisms for you on the right. And this is not just an equation, it also provides some intuition. So the assets of the entity on the left are really funded by 2 primary external and potentially internal constituencies: creditors who loan the enterprise money, and then owners, some of whom also may be employees, who are shareholders in the enterprise in the case of a publicly traded company. So the balance sheet is really providing information on the resources available to the enterprise, the assets, and then the claims on those resources, or how those resources were funded. And we'll start with the asset side of the balance sheet. So just a definition, what is an asset? It's really satisfies 3 criteria, which is a probable future economic benefit obtained or controlled by an entity as a result of a past transaction or event. And some examples: cash, accounts receivable, property, plant, and equipment. We separate assets into current and non-current assets. Current assets are going to be sold or consumed within a year or the operating cycle, whichever is longer. And for most companies, their operating cycle is shorter than a year. So current assets would actually normally be those that are going to be consumed within a year for most companies. And then non-current assets are held for a longer term use. And they are listed in order of decreasing liquidity, where liquidity means nearness to cash. And I'll show an example where we'll take a look at a balance sheet in a minute. Then if you turn your focus to the right side of the equation, so we have the assets on the left-hand side, we have the liabilities on the right-hand side. Those are obligations of business, such as payables, salaries, taxes, interest on debt. Those are as well segmented into those that are expected to be extinguished generally within a year. That's going to be what would be defined as a current liability for most enterprises. And then non-current liabilities will be those that will be extinguished over a longer period of time. And then we have last equity, which is the ownership claim on the assets of the entity. Equity holders are also referred to as the residual claimants. And the reason for this is because their claims are subordinate to the creditors if the entity were to go into financial distress or be liquidated. So for a given entity in general, because of this, what we call the pecking order here in terms of the order within which the obligations are satisfied, creditors have first claim to the assets. Liabilities for any entity are going to be less risky than the equity for that particular entity at a given point in time. So the cost of debt is always going to be lower than the cost of equity for the same firm at the same point in time, given this difference in risk profile. So one company I thought I'd take a look at was IC. And so IC was recently on my mind. So I decided let's pull up and take a look at IC's financial statements and use those statements to illustrate some of the concepts we just talked about. And so I have a question for you. Where are they headquartered? And hint here, they have moved recently. And where are they headquartered? All right, and it looks like majority rules on this one. It is also correct. They did recently move from Los Angeles to Laverne, Tennessee, which is about 20 miles, I think, southeast of Nashville, so greater Middle Tennessee area. So one of the reasons that they moved was 75% of their customer base is within a 1,000-mile radius of Nashville. So Nashville is very centrally located. So that was an attractive feature to them as they thought about relocating. And also when they announced the move, they announced that they're going to be creating about 200 jobs at a rather significant salary. So this was back in 2019. So they've kind of been on my mind since then. We probably all think back to our teen years, maybe when we had an IC. And I thought I'd like to learn a little bit more about them. But before we turn to them, I just wanted to do a sidebar here on another company that's recently moved to Nashville. And I think this one's got some interesting disclosures that I just wanted to make you aware of. So other companies have moved to Nashville, and I promise you I don't work for the chamber, but I really found this very interesting. I moderated a panel on which Alliance Bernstein was participating. So I had an opportunity to review their 10K and looking at getting ready for that panel. And one of the things I thought was very interesting was their reason for moving to Nashville. And they disclosed that the 10K is a wealth of information. So they talk about why they moved, and I've highlighted kind of the key things for you here: improve quality of life, attract and retain or recruit new talent, highly desirable location, and improving long-term cost structure. So this is the one that I think is really interesting, and I'm going to come back to this, is this notion of improving their long-term cost structure. And they further quantify that in the 10K and say they expect to realize annual expense savings of about 70 to 75 million per year beginning in 2025 once the transition is complete. And what I thought was interesting about this is, and we see this very often with companies when they go through some sort of change, they broker retention agreements with key talent. And those retention agreements have to be disclosed. And so in this particular retention agreement, which is straight out of their 10K, they refer to their chief talent officer and their chief operating officer and their CFO. And they note that they granted them each a special restricted stock award of about, or holding unit award of about $4 million. It's going to vest December 1st of next year. And it's conditional on several objectives, one of which is the executive team, the executive member has to continue to be employed by Alliance Bernstein. They have to move to and establish their principal residence in Nashville. And also they have to satisfy these criteria, which I thought was very interesting because a lot of these touch on things that we actually teach in kind of a general MBA program, that it's contingent on headquarter relocation being executed without significant disruption. So we have kind of this operational focus. They don't want any reputational damage. So this notion of marketing, branding, brand equity associated with the enterprise, they don't want anything going wrong there. Targets for cost savings and implementation cost have to be achieved. And now notice they've committed in that 10K to 70 to 75 million annual savings per year. So they are tying this $4 million award to each of their executives in part to achieving those cost savings. And I think why that's so critical is because a lot of times people just think of financial reporting as kind of counting the beans, but it's really much more than that, because we very often tie executives at-risk compensation to key metrics that are presented in those financial statements. So it's much more than simply reporting those metrics. I mean, people have a vested interest in ensuring that those metrics are achieved, striving to achieve those metrics, exerting the effort to do so. So there's a real economic incentive for that. And then also the level of workplace talent and diversity has to be satisfactory. And then again, consistent with best practices, they're going to advise each executive along the way. So if you're going to be evaluated, typically we would like to know, where do we stand? So they're going to advise each executive at December 19, 20, and 21, the compensation committee, whether or not they're on track so that they can, recalibrate, pivot, and adjust their performance if they're falling short of some of these goals. So really links financial reporting in a very powerful way to affecting change within the organization. So that's why I wanted to mention that. So now we'll come back to ICEE. So ICEE is actually part of J&J Snack Foods. And so I went and looked at J&J Snack Foods, and they are a publicly traded company. They are traded on the NASDAQ. And if you go to a company's website, you can look for a tab that says investors. And that's where you want to direct your attention, because that is going to contain a wealth of information. And once you drill into that area of a website, you're going to see these more commonly required financial filings. And I'm going to talk about some of these today. So I've got the filing here in the first column, and then the middle column tells you when it is due. So for example, the Form 10K is an annual filing. There are 15 required items. They are specified in Regulation S-K, which was promulgated by the Securities and Exchange Commission. And the filing is due 60 days after your fiscal year end. So if your fiscal year ends December 31, which is the most common fiscal year end date, you would have to file your 10K by around March 1st, which is why we get into earnings season and we see companies providing high-level earnings information, usually around mid-January. Then we have the ARS, or the annual report to shareholders. That's the glossy. It has the pretty pictures, not required. Some people think that is a required filing. It's not. The 10Q is a quarterly snapshot of the 10K. It's much less detailed than the 10K or the K. We have the 8K. The 8K is also called the current report. Companies are required to file these within 4 business days of a triggering event. Whenever I'm doing research on a company, one of the first things I do is go and look at their current reports or their 8Ks, because if they've had anything significant happen within the company, so if somebody's joined the board of directors, if somebody's resigned from the board, if there's been entry into a materially definitive agreement, if they've declared bankruptcy, if they've announced earnings, all of these things are going to be filed on a very timely basis within an 8K. So it's a very useful form to go immediately to get a snapshot of what's currently going on with the company. The Schedule 14A, it's also called the proxy. We'll take a look at some of the information in the proxy. That's what contains the shareholder proposals that are going to be voted on at the annual meeting. If there's a significant entity that becomes an owner within the company, takes on 5% or more of their stock, so you have a block holder that becomes a part of their equity structure, they'll file that. And then the forms 3, 4, and 5, which we won't talk about today, but those are the so-called insider trading forms. And that's a descriptive term, which means that insiders, so that's people within the company who are defined by the SEC as insiders, are buying or selling in the firm's stock. So insider trading is descriptive. It is not illegal. What is illegal is trading on insider information. That's where you go to jail, for those of you who may remember a few years back with Martha Stewart and others. So went to their 10K. So this is the cover page of their 10K. And you see there the ICEE trademark there. And they have other products that they sell. And they start off with a kind of a financial summary or highlights. And you can see here they highlight their sales, their earnings. So both of these are going to be provided on the income statement, which I'll represent by I/S, which we'll talk about in a little bit. And then you see the information here, the assets, long-term debt, capital leases, and I'll just move it here so it's out of the way, on the balance sheet. Um, uh, which I'll represent by B/S. So all of that information they summarize for you for the past 10 years that we can all pull from their balance sheet. And we will look at their balance sheet in a minute. And then you see their earnings per share, which is going to be disclosed on the face of the income statement. That's a requirement. It's a key performance metric. We'll look at that in a minute. And the number of shares they have outstanding. They also disclose the dividends that they pay per share of stock. So here's their 10K. So remember I said that there's 15 items and you see them, they're listed right here. So we have 15 items. So the SEC essentially gives you a template and you have to respond if you're a publicly traded company to the questions and the requests for information that is represented in each one of these items. We're going to focus on item 1, which is the overview of the company's business, and then item 8, which contains the financial statements. You'll see there's other items here as well that we won't talk about today, but those items also are going to be disclosed in some great detail in the Forms 10K. So we look at the business, which I just excerpted from item 1. So it talks about what the J&J Snack Foods is. So we're a snack foods company. We distribute frozen beverages. We market those nationally to the food service and retail supermarket industries. And our principal snack food products are, and then they go on to list all their brands. They tell you the year they were incorporated and the state of incorporation. That's a required disclosure. They also tell you that they have made acquisitions. And they're going to discuss those in more detail in management's discussion and analysis, which we also refer to as the MD&A, management's discussion and analysis of financial conditions and result of operations, which is also a very useful disclosure where senior management is providing a high-level overview of how the entity is performed, what's the reason for things that have gone well, and what their explanation is for things that may not have lived up to expectations. So you're hearing from the senior management team when you look at that section, and they attest to this, that the information they're presenting to you is, to the best of their knowledge, truthful. So if I look at J&J Snack Foods, item 1, so they're in 3 business segments, as we saw in the previous slide: food service, retail supermarkets, and frozen beverages. Frozen beverages is really kind of what I was just interested in. We see their frozen beverages, the names they market those under. It's about 10% of the company's $1 billion in revenue, so a smaller component of their product mix. And you can see, as you might expect, given the pandemic, that was down relative to 2018 and 2019. And that's also discussed at length in the 10K, the impact that the pandemic had on their sales. And it also came up in their earnings call. And some of the analysts, I read the transcript of their earnings call yesterday, which again, that's public information. You can get it off their investor website. The analysts were asking them about the effect of the pandemic on their sales of frozen beverages and when they thought that that was going to abate, because you can see we're down on revenue there. So here's their balance sheet. So I'm looking at the asset side first, and you can see the assets are listed in decreasing order of liquidity. So remember, decreasing order of liquidity means nearness to cash. So how readily convertible is something to cash? So cash and cash equivalents would be first, because that's already in the form of cash. And you can see on the date of the balance sheet, and remember that the balance sheet provides a snapshot of the financial position of the entity on the date of the balance sheet. We can see that they had about $195 million in cash. These amounts are all in thousands except the per share amounts. And then we see, as we move down, represented by the green arrow here on the left, the assets become less liquid. So marketable securities would tend to be more liquid because there's an active market, stock market, in which those could be liquidated if necessary, then accounts receivable and so on. And then we get down to the the non-current assets. Here's the current assets. And then down here, we have the non-current assets are starting right here for us. And remember, those are the assets that we expect are going to be held for a year or longer. And we see property, plant, and equipment, which is one of the most common that companies were going to have. And we also see goodwill. So goodwill is going to tie back to what was referenced in the discussion by management regarding their acquisitions. So you might want to ask, what is goodwill? So goodwill, when I do sessions, people always want to know, what is goodwill? I've heard what this is, but I don't know what it is. So it arises in an acquisition when an acquirer pays more than the fair value of the identifiable net assets that are acquired. So you purchase the identifiable net assets. So that's the assets net of any liabilities. Those are revalued to fair value on the acquisition date. And if you pay more than the fair value for those, that difference is called goodwill. So if you look at this IC distributor here that they bought in Bossier City, Louisiana, they paid about $45 million for that. And if you look at the goodwill, they paid about 15 million, or they recognized rather 15 million in goodwill. So 15 million in goodwill. So you could think of that as they paid about $15 million more than the fair value of the assets. And so you might ask yourself, why would somebody pay more for the assets than what it's worth? Why does that happen? Well, companies have to tell you why they do that. That's another great thing about the financials. They answer a lot of your questions. So they have to tell you why. So straight out of their goodwill, their 10K rather, they say the goodwill recognized is attributable to the assembled workforce of each acquired business and certain other strategic and tangible assets that don't meet the requirements for recognition. So we do not put human capital on the balance sheet. So if you're a human capital intensive business, if you're AllianceBernstein, if you're a consulting firm, even if you're General Motors, the value of your human capital, your executive management team, they are not on the balance sheet as an asset. We don't recognize them as assets in accounting because it's too difficult to quantify and measure those for purposes of recognition on the balance sheet. So that's what this goodwill is. They're saying we're basically buying these other things and we can't value those. And what are some of those things? Well, workforce being some of them, and also strategic and tangible assets could be things like distribution networks, alliances, things that are very difficult to value, but that they are willing to pay a premium in order to fold into their corporate entity and then hope that the benefits associated with those are realized. Now, if they're not, they then have that $15 million in goodwill that they have to write down, because then they'll say essentially later, the goodwill really wasn't worth the 15 million. We had to write that down. And you tend to see a negative stock market reaction when that happens. That's essentially saying I misvalued how valuable this company was going to be to me, and some of these synergies that I was anticipating weren't realized, and I had to write the goodwill down as a result. On the left side of on the right side rather of the balance sheet, we have the liabilities and shareholders' equity. So again, liabilities issued in decreasing order of when they need to be extinguished. And one thing I didn't point out, but J&J has no long-term debt. So they actually have very little debt on their balance sheet. So you don't see debt there. So what do we use the balance sheet for? Well, liquidity helps us assess the amount of time that's expected to elapse until an asset is realized or converted into cash, or until a liability has to be paid. Creditors are interested in that in the short term, because liquidity indicates whether or not they will be able to repay an obligation. Also speaks to the issue of solvency. Can the entity continue to remain as a going concern? If they have a high level of debt relative to assets, they have less solvency. And also liquidity and solvency affect an enterprise's financial flexibility, which is really the extent to which an enterprise can take effective action to alter the amounts and timing of cash flow so that it can respond to unexpected needs and opportunities. So stated a bit differently, if an unexpected opportunity comes along, is the enterprise in a way eligible to be able to kind of pivot and adjust and find the resources that it needs in order to avail itself of some unexpected opportunity that may have been presented to it. So that's why financial flexibility is so attractive, is because the business environment's uncertain. We never know what opportunities may present themselves to us. So better financial flexibility enables us to opportunistically respond to favorable or potentially unfavorable developments, think COVID, that may occur in the environment that we're outside of our control. Now, one of the ways we summarize financial ratios, financial statements rather, is with financial ratios. And that helps us analyze the firm's performance and its riskiness. And we really group those into speaking to 5 broadly construed constructs: liquidity, which is how able the firm is to raise cash quickly; debt repayment, how strong is their ability to repay money they've borrowed; asset management, how effective are they at utilizing the assets in its asset base. So again, if you think about that accounting identity represented in the balance sheet, assets equals liabilities plus shareholders' equity. So creditors and shareholders, so over here on the right-hand side, they provide funds to the entity, which the entity uses to fund assets. So certainly they are interested in the extent to which management is effectively deploying their talent and their resources to manage those assets to engage in profitable endeavors and provide a return to the individuals on the right-hand side of the equation for using their capital. Profitability, another key metric we look at, and then return to investors. Can the firm provide an adequate return to its investors? And that's really the 5 areas that we look at for financial ratios. And we generally calculate more rather than a few. You don't just look at a couple. I've got them grouped here for you by the previously stated categories to give you an indication of what some of the measures are that we use to measure liquidity, debt management, asset management, profitability, common one being margins, which we'll talk about in a minute, and then return to investors, such as earnings per share, return on equity, return on capital employed, the PE ratio, a very commonly used metric as well. So the balance sheet, as I mentioned, we can assess liquidity with that. So that refers to, again, our ability to meet our short-term obligations as they're due. Working capital is really the difference between the current assets and the current liabilities. So if your current assets exceed your current liabilities, you have positive working capital. I think of that as capital at work. So the funds that the firm has to facilitate or fund its day-to-day operations, there's a number of ratios that we can use to assess the firm's working capital. The most important working capital accounts that relate to the firm's operations are on the balance sheet and the income statement. And some of the key ones that we saw on the balance sheet just a minute ago are days receivable outstanding, sometimes called DRO or DSO for days sales outstanding, which measures how many days it takes you to collect on your receivables. Days inventory outstanding, how fast you sell your inventory. And then days payable, which is how many days on average before you pay your bill. So these are kind of key activities associated with the effective management of working capital. And these can be calculated using the public financials for those of you who would have access to this information at a more granular, disaggregated level, say at the division level. You could do this at the division level. I couldn't do that from your public financials, but you could do that internally in assessing the effectiveness with which one division is managing its working capital relative to another. And working capital management is really critical. And kind of the rule here, and I've got this on the right-hand side, you want your DRO as short as possible. So you want to collect those receivables as fast as you can. You want your DIO to be as short as possible. So you want to move that inventory out as fast as possible. So shorter amount of time you've got capital tied up in inventory and you're converting that inventory to cash by selling it, the better off you are. DPO works the opposite. You want to delay as long as possible in paying the cash that you owe. So I indicate that over here with the bullets here. You want to collect cash as quickly as possible, pay cash as late as possible. Now, the interesting thing, the tension here, your customers want the opposite, right? So this is why this is a management act. It's a balancing act. This has to be kind of an intentionally thought out activity on the part of the enterprise, often in collaboration with other stakeholders in the entity. So much easier said than done, which again, I think is what makes management a very interesting pursuit just in general. If we could just turn the dials on these things and do this without any kind of tension, that's really not interesting. Anybody could do that. The management function is really thinking about how to do this in kind of an intentional, meaningful, constructive, win-win, productive way. So if we think about the days receivable outstanding, payables outstanding, and inventory, you can think about the cash gap. And just a picture here. So you buy your inventory. So your inventory arrives, and generally you're going to buy that on account. So you're going to say, I'll take delivery of the inventory. You send me a bill. I'll pay you in 50 days. I've pictured 30 days here. So I have 30 days where I'm kind of sitting on the payable. Again, I want to extend that as long as I can before I pay out the cash on the inventory I bought. And so at 30 days, I'm going to pay that bill. I've got this inventory, which I'm assuming I'm still just holding it here. Finally, at day 50, I've got somebody who's bought it. Well, they've bought it from me on account too, but they're now receivable to me because I'm waiting to receive cash to them. It was a payable back here because I was the one paying cash. Over here, I'm waiting to receive cash. So this cash gap is really kind of like when you're flying without a net, in a sense. You've paid the cash on the payable and you're waiting to collect the cash from the customer to whom you sold the widget. And that's the cash gap or the operating cycle. And we can measure that or approximate that by taking days receivable outstanding plus days inventory outstanding and then subtracting days payable outstanding. Shorter cash gaps are desirable. So again, thinking about how do we do this kind of intentionally and effectively by managing or turning the dials in a way that beneficially benefits the enterprise. And this gets even more interesting. I've done some work with companies with global footprints. It gets even more interesting when you think globally about this issue, because although it may be a standard convention in the United States to pay your receivables within 30 days, that is not the case in many countries outside of the United States. The standard could be 60, 90, 120 days, depending on where in the world you're operating. So thinking about this on a global scale and kind of how do you fund this cash gap? I mean, we don't just close the door. We have to kind of keep the business running is really one of the functions that the treasury function within the company would work on. And of course, the financial reporting would be essential to that management process. So once we've calculated these ratios, as an example, days receivable outstanding, payables outstanding, days inventory outstanding, how do you interpret those? So if you tell me your days receivable outstanding is 4 days, I really don't know how to interpret that. Sounds short, but I really don't know how to interpret that absent a benchmark. And there's really kind of two benchmarks. I could look at your performance through time, or I could look at you relative to peers. So I could look at you relative to peers. Whenever I want to identify peers for a company, I go to their 10K, I text search for competitors, and I identify the companies that enterprise tells me are its competitors. So I don't go to Yahoo Finance and rely on that. That's a derivative resource. I would go to the 10K and say, who does Johnson & Johnson say are their key competitors? That's who I'm going to look at. And then I'm going to either look at that through time or relative to your competitors. So back to my example of 4 days. 4 days receivable outstanding sounds quick, but what if that's up from 2 days? Many companies have 2 days receivable outstanding, especially if a lot of their business is driven by credit cards. Or what if relative to your peers, the days receivable outstanding is 10 days? Then maybe 4 looks very good. So I need a benchmark here. And so identifying a benchmark to interpret these things, either comparing the firm relative to itself or comparing the firm at a point in time to key competitors, is critical. If we move on to the income statement or the profit and loss statement, that's formula. If you want a formula, it's revenues minus expenses equals earnings. So just to recap, the formula for the balance sheet was assets equals liabilities plus shareholders' equity. Income statements, revenues minus expenses. This is a flow statement, gives me the performance over a period of time. Earnings are not the same thing as cash. It's prepared according to accrual accounting, which, if you want to know the definition of accrual accounting, it's right here. There's a reason that we do accrual accounting. It's not to drive people crazy or ensure lifetime employment for accountants. It is because, and there's a lot of research to support this, that earnings that are based on accrual accounting as opposed to cash-based earnings are a better predictor of the future net cash inflows to the enterprise, which is ultimately what we're interested in doing, is predicting future cash inflows. Cash inflows and outflows today is not as strong of a predictor of future cash inflows as our current earnings today. So that's why we look at earnings kind of in a nutshell. Here's J&J's income statement. You can, oops, let me go back to that. I'm going to come back to it in a minute. So you see here at the top, we have the sales, and we see they had about $1 billion in sales here. This is for the 52-week period, ended September 26, 2020. We have the expenses here. So we subtract expenses to get to our bottom line earnings, which you see here. You see earnings pretty substantially down, 20 over 19, and then earnings per share, and key, also referred to as EPS, key performance metric that security analysts pay a fair amount of attention to. You see earnings per share as well disclosed on the face of the income statement as it's required. That helps us evaluate past performance, predict future performance, assess the uncertainty of the future cash flow, and predict the amount, timing, and uncertainty of those cash flows. And this is what I mentioned before, that the nature of accrual accounting facilitates that prediction process and helps us assess profitability, investment value, and credit worthiness. Now we can calculate some ratios off the income statement. A common metric used are common size financial statements, where we would just divide all the line items on the income statement by top line revenue or sales. And then that let us look at the firm's expenses as a percent of sales through time, or at their margins as a percent of sales through time. And I'm going to look at that in a minute. And again, we can also then compare the firm to another firm at the same point in time. I've done that for you here for J&J. I looked at their gross margin, operating margin, and their profit margin. I just took the numbers here that are in the red arrows that you see here, and I divided those by sales. So gross margin of 23.3% tells me that for every dollar of revenue, I have about 23.3 cents of earnings left over after I have accounted for the cost of the goods that I sold, essentially all the manufacturing costs that were sacrificed in the production of the product, which would be direct material, direct labor, and variable and fixed manufacturing overhead. And again, you can see my margins not trending favorably for me. They're going the wrong way. They're going down. You see the profit margin here. We were at 8%, and now we're down to about 1.8%. So a nice snapshot way to look at our margins. I could then compare these for J&J to competitors to look at the trend, as well as where we are at a point in time relative to a competitor. If I look at their MD&A, which is item 7 of the 10K, they're going to explain to me why exactly that gross profit that I talked about on the previous slide, why did it decrease? Well, we noted that in the calculations we did. Well, because of lower volume in their food service and frozen beverages, higher costs related to production disruptions due to volume mix changes, expenses related to employee safety, and increased COVID-19 compensation. They also note that their operating expenses decreased. They decreased about 12 million, but as a percentage of sales, they actually increase. So that's, again, that's going the wrong way. And they explain why. Well, fixed costs. Well, fixed costs, what happens with fixed costs? Fixed costs are costs that an organization cannot unwind in the short run. It's a definition of a fixed cost. So when volume decreases, the fixed costs are still in place. Fixed cost per unit that increases, which has a negative impact on profitability. We saw that with J&J Food Service. We also saw their earnings per share was disclosed on the face of the income statement. That's a requirement, has to be there. It's a widely followed measure. Analysts closely track it. If you fail to achieve earnings expectations, suffer significant share price declines, possibly shareholder lawsuits. Also, if you're the CEO, it increases the likelihood that you will be fired. So let's think about the DuPont decomposition of these ratios. So I'm going to take two. I'm going to take return on assets and I'm going to take return on equity. And you may have heard of these measures, but what I'm going to do is I'm going to decompose them into, for ROA, asset turnover and operating profit margin. So you multiply these two together, you get return on assets. So that's going to give me a more granular insight to the return on assets of the enterprise. I can also do that for return on equity, and that's leverage times asset turnover times profit margin. So you see what I'm getting here is a sense of profitability in the form of margins. And I'm also getting a sense of effectiveness in how they deploy the assets, and return on equity also speaks to the issue of leverage. As firms increase their leverage, that increases the return on equity to the enterprise. So there's the equations: operating margin times asset turnover, profit margin times asset turnover times leverage. That gives me insights. So these are the levers that you can beneficially increase: ROA and ROE. And it's really important to drive home the intuition behind these measures. It's one thing for me to say, go forth and increase your ROA. But it's much more intuitive to think, well, how do I increase ROA? Well, if I can make my margins higher. Well, how do I make margins higher? Well, make revenue higher. How do I do that? Revenue is price times quantity. Increase price or increase quantity, or do some combination of both. And there's tension here. I'm not suggesting you can just increase your price. Or reduce your expenses. Asset turnover. I want to improve the effectiveness with which I deploy my assets. Well, how can I do that? Well, collect on my receivables faster, sell my inventory faster, take longer to pay on my payables. So it really gives you insight into the levers that you can focus on. I've done this here for J&J Snack Foods. Here's their return on assets. And you can see their return on assets fell pretty significantly. What really killed them was operating margins. So their asset turnover's down a little bit, but really what killed them was their margins. If we look at their profit margin, which was about 1.8%, you can see, again, the asset turnover is going to be the same for both of these. Their leverage here pretty much constant at 1.26. They're not a highly levered firm. Really, again, the story here is that the margins really is what is driving, to a certain extent, this decline in return on equity. So again, the decomposition is not just fun with math. It's to give us insights into what's going on. It also speaks to the issue, we don't have time to discuss this, but of competitive strategic positioning, because asset turns are more difficult for the market to imitate. So competitors have more difficulty imitating, gives you a higher competitive advantage. It kind of increases the barriers to entry. Think Walmart, extremely effective at asset turns. We don't have time to talk about that, but it does give you some insights on that. So the balance sheet, again, there's our equation here, gives us the financial position at a point in time, the assets and the claims on those assets, the income statement, and again, it's a flow statement which measures performance over a period of time. And here's the current assets from the balance sheet. Here's cash. How did the firm use its cash? So cash decreased about $3.5 million. We have an entire statement, the statement of cash flows, that tells you how the firm used its cash. And firms are required to disclose this, and they have to tell you how they use their cash in investing activities, financing activities, and operating activities. So they give you a sense of their cash utilization. And so it helps us assess how successful the enterprise is in generating cash, evaluate the trends in cash, and the reasons cash has changed, help us evaluate liquidity, solvency, and financial flexibility. Also a useful place to start to calculate free cash flow. And so you see one way that the financials articulate is that the change in cash on the balance sheet is actually the sum of cash flow from operations, cash flow from investing, and cash flow from financing on the statement of cash flows. So really, to be a sophisticated user of financials, you want to understand the interactions, the interplay, the articulation between those statements. And we can see here their operating cash flow. Again, you look at receivables, inventories, and payables. You see those here. Those have direct implications on operating cash flow. So the ability to effectively manage those accounts has an impact on the firm's operating cash flow. We can calculate free cash flow, which is to give us a sense of the amount of cash the firm has after running its operations and maintaining its ability to produce, that is in theory available to invest in shareholder value. General Mills is a big proponent of free cash flow. So they actually calculate their free cash flow just the way that we did. They took their operating cash flow right here. They subtracted their expenditures on PP&E, which is maintaining their ability to produce. And you see they have free cash flow of $3.2 billion. What gets measured gets attended. So put your money where your mouth is. General Motors, this is straight out of their proxy. They tie executive key bonus or at-risk compensation to their ability to generate free cash flow. So here again, why do you care about these accounting metrics? Your compensation and your career progression, and in fact, your job likely often depends on these metrics. How's the stock price doing? Item 5 of the 10K. You have to tell me over the last 5-year period, how is your stock performing relative to 2 broad-based benchmarks? And so if you look here at J&J, you can see we're down here relative to the NASDAQ composite. Remember where they're trading over the last 5 years. We're not doing as well, but this is a really nice summary statement to get a sense of how's the stock price performing. Required to disclose this in item 5. I was recently looking at this for a company I was doing some research on. Called the company up because I couldn't find it, talked to their investor relations, often a very useful source of information. They chose to lie to me, which was unfortunate. So I turned them into the SEC. So I wanted to make sure you knew how to do that. You just go to the website for the SEC. Here it is. This stands for Tracing, Contacts, and Reporting. You can actually submit a tip. So I actually uploaded the defective disclosures, reported them to the SEC for defective financial disclosures, and I can tell you I will never own stock in that company. Earnings calls. After the earnings are announced, hosts an open earnings call, meaning anybody can listen, has a very standard format. I tell my students, go look at the earnings call in an interview with the company. So what is the CEO and the CFO talking about? What is Wall Street asking? The Q&A is very insightful. So the financial reporting provides a wealth of information. It's the raison d'etre is to aid decision making. These disclosures are all publicly available. The public nature of them should also discipline managers to undertake actions in the best interest of shareholders because it's out there, it's in the public domain. Now, if they fail to do that, we call that non-transparent or opaque financial reporting, as the example I gave you a little bit ago that I put the Securities and Exchange Commission on. We don't like that. And if you go too far with that, you'll go to jail. So where do you start? Go to their investor relations website, look at their most recent 8Ks for recent developments, read the 10K. We looked at some of the excerpts here. Study the statements, think about some financial ratios, read analyst reports, read the recent CEO, CFO interviews, and earnings calls in particular. That's where to start. And I am done. So Nate?
Thank you so much, Richard. This is very insightful. If you have any questions, the Q&A button below at the bottom of the Zoom is where you want to go. One question that popped up was, will these slides be made available after the presentation?
Yes, absolutely. We're going to make the slides available.
Yeah, I would.
Cheryl has them.
Okay, I would add to that this recording, this is being recorded and will be up on our YouTube page shortly after. Okay. Well, I think that about does it for us. Richard, thank you so much for taking the time. This is very insightful. For everyone out there, thank you so much for participating this morning. I know you have a lot on your plate, so thank you for spending an hour with us. If you want to learn more about the upcoming live online course, Speaking the Language of Business, please visit business.vanderbilt.edu and click on Executive Education for more, or you can contact Cheryl Bates at the email address and phone number below. Thank you all for your time, and have a great rest of your day.
Thank you. Thanks a lot.